Hey, how's it going everyone? In the previous videos we have been talking about market psychologies. Well, I'm really sick of it. Let's talk about something else today. We'll talk about entries and how to use VWAP and opening range breaks, or we call it ORB, to enter and exit trades. Who cares about emotions? We're only humans after all, don't put the blame on me. Anyways, let's get started. I'll keep it as simple as possible. There's a few simple prep work you gotta do before considering entries on any stock if you're gonna follow these methods. Step number 1. Set your expectations straight. Your portfolio and your losses are gay enough already. I'm just joking. Try not to lose more than 2% of your account every time you're wrong. If you're trading with a $10,000 account, even if you buy 3 contracts or 4 contracts or 5 contracts, your overall loss shouldn't be more than $200, which is 2% of your entire account, even if you get stopped out. But Mario, you said you're not going to talk about emotions or risk management. Shut up. With that being said, let's talk about how to draw these opening range breakouts first. So the market opens, you wait for the first 5-minute candle to close. Once the first 5-minute candle closes, you're going to draw a line on the highs of the first 5-minute candle, and you're going to draw another line at the lows of that first 5-minute candle. Well, that's it. There we go. The highs of the first 5-minute candle is what we call as ORB highs, and the lows of the first 5-minute candle is what we call as ORB lows. Easy. Some traders do the same with a 15-minute time frame. They wait for the first 15-minute candle to close and draw the highs and lows of the 15-minute candles, and some traders do the same with the 30-minute time frame. Well, the backtested data, which goes back all the way to 1 decade, shows that the 5-minute time frame gives you better results with minimal drawdowns. So I'm going to stick with 5 minutes. But if you're going to go with 15 minutes or 30 minutes, well, that's fine as well. It all depends on how long you hold on to a trade after you click on that buy button. Well, you got 2 lines sitting in your chart right now. Yay, big oops. Now what to do with it? Now you wait for the markets to show their hands, sometimes until 10 a.m. gives you a better idea. Wait for the stock to either pull back towards this ORB lows or reject the ORB highs. In this example, you can see how the stock pulled back towards the ORB lows, and every time it did, you can see them log a fat green candle followed by multiple retracements. Every time it came close to this ORB lows or tagged this ORB lows, the buyers stepped in shorter time frames. In this case, I'm looking at 2 minutes. Now this is where I'm going to take a chance. You see a fat green candle on a 2-minute time frame off of this ORB lows. So I'm going to long the stock here. When I say long it, you can buy calls, you can buy shares. When I say long, I'm bullish. I'm going to long the stock right here, and I'm going to set my stop losses right at this lows. The beauty about this is you exactly know when to cut your position for a small loss, and you can always re-enter once the same setup is offered again. Now you can see what happened later. The price tagged the ORB lows and continued to keep pushing further. Now the next question becomes where to exit, where to take profits. This is where your initial risk comes into play. Remember when I said don't risk more than 2%? Let's say in this scenario the 2% of your account is $200. Now let's say the price goes up and the contracts appreciate $200 in value. Now you're going to trim some of your positions right there because you just made what you could have lost if you get stopped out. You leave the runners by moving the stops to break even, and if they push towards $400 in profits, which is 2 times your initial risk, this is where you're going to make the second cut. You're going to take the second half of your profits off the table. Trading this way is going to keep your risk to reward in check. Now let's go over more examples. In the same chart, you can see how many times those ORB lows have bought in buyers. If you took this trade, well, you're most likely done trading for the day within 2 hours into the market open. Less stressful. Now let's go over more examples right now with different ticker symbols. Let's talk about what happened with SPY today. Just do the same procedure. First 5-minute candle, draw the highs and lows. That's going to be the ORB highs and ORB lows. Now what are we going to do? We're going to wait for a nice reversal candle on the 2-minute time frame. We're not going to take anything until all the data drop is done anyway. So we got that liquidity grab right here at that 10:08 candle. You see how they wicked us out right here? Markets are tricky. The job of the market is to make as many traders look as foolish as possible. In hindsight, it makes sense, but when it's happening in real time, this can be really frustrating. You see a liquidity grab and then a follow through. That liquidity grab lows at the 2-minute candle gave you a nice area to set your stop losses on. So let's talk hindsight for a minute. Did you notice how the 2-minute time frame never broke under the ORB lows? Where did the buyer step in over and over and over again? Near that ORB lows which we drew from the 5-minute candle. Now let's go over another example. Look at the ticker symbol NOW, now, ServiceNow. Go to the 5-minute time frame, draw the ORB highs, draw the ORB lows, same exact template. Well, I said I wouldn't talk about psychology, but think of me like a crackhead who couldn't help himself. Did you notice something? All I'm doing is nitpicking setups which actually worked and which actually fits my narrative of the topic which I'm talking about. I know most of my audience are new. I don't want to give you any idea that the ORB is the holy grail of trading. There is no holy grail. Now let's talk about the setups which didn't work and also talk about how you go about managing them. Let's talk about Microsoft. Go to the first 5-minute candle, draw the highs and lows. That's going to be ORB highs, ORB lows. After 10 o'clock, what happened to the price? It is not as clean as the setups which I showed you. The price has been doing the back and forth near the ORB lows, getting above it, getting below it, getting above it, getting below it, and then finally broke through with a nice candle. Now in hindsight it makes sense, but when it's happening in real time, how do you deal with this? Let's say you're entering right here at this backtested 10:20 AM EST candle. Now your stop losses should be at this lows of that 9:50 AM candle. Now when you set your stop losses at these lows like this, it's going to avoid you from micromanaging your trade for every red candle which you see on the 5-minute or on the 2-minute or on the 1-minute time frame. You're just going to set your stops at a place which is at the lows of the day, and you're going to know that you're wrong if it hits your stops, and if it continues to push through the upside, you're just going to manage the positions based off of how much you're risking initially when you open this trade. Now let's talk about another tricky one. Let's talk about Tesla. Go to the 5-minute time frame, mark the highs and lows, and wait for the 10 o'clock candle, and look at what happened later. The price was trading under both ORB highs and ORB lows. What to do now? I'll tell you what to do now. You just leave this the fuck alone. That's what you do, and we just leave it alone and look for other setups to trade. Let me be clear, there are gonna be some traders who will be taking advantage of these types of price actions where the price is just range bounding between two levels. Well, that's not in our system, so we're going to stay away from it. So as you can see, there is a multiple variations of the same thing which we discussed about earlier. It follows a simple principle. Support will turn into a resistance, and resistance will turn into a support once it's broken to the upside or to the downside. Here's a fun exercise for you guys to do. Go ahead and check out what happened to the price of Microsoft after they broke above the ORB highs. Look at where the buyer stepped in every single time. ORB highs, once broken to the upside, has potential to turn into a support, an area where the buyers might step in over and over. And so does for the ORB lows. Once broken to the downside, the same ORB lows will have a potential to turn into a resistance where the sellers might step in over and over. Did you notice my vocabulary? How I'm saying might happen has the potential to happen, because we can't predict a random outcome. It's a game of probability. Even if you have a win rate of just 40%, but if you have a risk to reward ratio of 3:1, which means if you risk $100, you're making $300 on every single trade you take, over the span of 100 trades, your portfolio is still going to stay profitable. Win rate on its own doesn't really matter. Win rate alongside with risk to reward does. So ORB is a decent entry strategy which a lot of traders use, and it has a decent backtested data with minimal drawdowns. I just wanted to share how it works with all of you, especially most of you are new here. Well, if you found the video informative, leave a like, subscribe. Did you do it? Imagine listening to a random guy on the internet and clicking buttons. Yeah, don't unlike now, don't unsubscribe now. Take high probability trades, manage the risk wisely. I'll see you guys tomorrow. Bye-bye.